Moving on to Chapter 3, the second chapter in our accounting review. The focus of Chapter 3 is on ratio analysis. Recall, management's overall goal is to maximize shareholder wealth, which means maximize the stock price, which means minimize the cost of capital. To do that, we have to figure out what's driving the poor performance of a firm and what to do to correct the situation. Chapter 3 continues the Computron case from Chapter 2. In this chapter, Computron has evaluated 2018 and 19 and estimated their performance for 2020. If you want to follow where the numbers are coming from in each calculation, you might want to print the financial statements from this PowerPoint. So let's get started. A firm's debt and equity mix and business risk, among other factors, affect the company's cost of capital, which directly affects the value of the firm. Ratio analysis is fundamental in both accounting and finance. Ratios let us compare our own firm's performance over time to identify strengths and weaknesses. They also facilitate comparing our own numbers to our peers and aspirant firms, who we want to grow up to be. Ratios are also used by investors and lenders for the same purposes. There are thousands of ratios, many specific to certain industries. For our academic purposes, we'll focus on 5 major categories of ratios designed to evaluate a manufacturing firm. The formula for all these ratios are in Appendix C of your book. The first 2 categories are detailed above, and all should look familiar to you. Liquidity, current and quick ratios. How prepared is the firm to meet current cash needs? And asset management. How well the firm is managing its assets to generate sales. Debt management measures how well the firm is managing debt in their capital structure. Profitability, of major concern to investors, particularly the ROE. Market value ratios are the only ones that use data outside the income statement and balance sheet. For these ratios, we need the current market value of the firm's common stock. Here's Computron's 2019 income statement and their estimate for 2020. Note that they're projecting more sales growth and they expect net income to grow as well. Again, 2019 and 2020 estimate. The asset side of the balance sheet. Total assets and accounts receivable are expected to increase again. On the liabilities and equity side, Computron is projecting to decrease notes payable. Shareholders will be thrilled to see the projected stock price for 2020 increasing significantly from 2019. EPS swinging almost $1.50 per share and the dividend returning to previous levels. Profitability ratios pretty obviously measure how well the firm is generating profits. Net profit margin is simply the bottom line, and it's also called the profit margin on sales. It measures profit per dollar of sales. While the projected 2020 profit margin is expected to improve, it's still well below the industry average. Operating profit margin measures how well the firm is performing before taking interest payments and taxes into account. Again, the firm has improved, but is still below the industry. Basic earning power shows the earning power of the firm's assets before the influence of taxes and leverage. Basic earning power can be used to compare firms with different tax situations and degrees of financial leverage. Obviously, there's room for improvement here as well. ROA and ROE are 2 measures of the firm's ability to generate profits on assets and a return on common equity. ROE tends to be the metric more frequently looked at by investors since it specifically measures the return on funds supplied by common equity holders. Comparing Computron's forecasted 2020 results, we see that while both measures have improved, neither are up to the industry averages yet. This slide will probably take some thinking. Debt lowers ROA because it lowers the numerator, net income, without affecting the denominator, total assets. On the other hand, debt can increase ROE because while it lowers the numerator, net income, it also lowers the denominator by changing the debt-equity mix. Asset management is critical to a firm's success and profitability. A firm must use its assets to create sales and profits. That's the whole point of owning assets. Inventory turnover measures how many times a year a firm totally sells out its inventory. This is very much an industry-specific number, since you would expect, say, a grocery store to have a much higher inventory turnover rate than, say, a heavy equipment manufacturer. Computron has been well below the industry average of 9 times a year. Typically, this means poor inventory control or outdated products still in inventory. The forecasted improvement brings the firm closer to the industry average. Day sales outstanding measures how quickly the firm turns accounts receivable into cash. Again, this number must be compared to industry standards, as some industries run with higher DSO numbers than others. Assuming a standard net 30 days credit policy, 29.3 days is very good. With an industry average of 28, we can pretty well assume 30-day net is the industry standard, making the firm's 29.3 look good, and Computron is improving. Both these turnover ratios measure how well management is using assets to generate sales. Again, these must be compared to something to be relevant. This slide says it all. Fixed asset turnover is significantly better, but much below the industry average, as is total asset turnover. Too much accounts receivable and inventory. The current and quick ratios will help answer the question as to the firm's expected liquidity. Computron is projecting a relatively strong current ratio for 2020 at 1.9. This is one of the few ratios that has a definite benchmark. It needs to be greater than 1. The quick ratio of 0.9 excludes inventories, yet is still relatively strong at 0.9. One problem with ratios is that they are very difficult to interpret in isolation. You have to compare them to something. Last year, industry averages, a peer. Though Computron is projecting improvement for 2020, they're still not up to the industry averages. And remember, industry averages are just that. They're average. You want your firm to be better than average. If a firm is using debt in its capital structure, and Computron is, then these ratios attempt to measure if the firm's debt level is appropriate and if the firm is able to meet their debt service requirements. As we go through these ratios, keep the general format of the balance sheet in mind. Left side, total assets. Right side, total liabilities plus total equity. Total liabilities equals all liabilities, not just long-term debt. The debt ratio is long-term debt plus notes payable. Debt ratio is the percentage of debt in the firm's capital structure, and 24% does not appear extremely high. Debt to equity measures the ratio of debt to equity. This ratio shows the percentage of the firm not financed by equity, meaning the percentage of equity is 1 minus 0.36. The equity multiplier is used in the DuPont equation, or the DuPont identity, which we'll look at in Part B. Times interest earned is also called the interest coverage ratio. It tells us if the firm is earning enough to cover their debt payments. A coverage ratio of 6.2 is relatively strong, indicating Computron has sufficient earnings to pay the interest on their debt. This is a ratio a lender would be concerned with in considering extending more credit to the firm. And finally, the EBITDA coverage ratio is a refinement on times interest earned. It considers the fact that the depreciation and amortization are non-cash charges and that lease payments are fixed charges. Leasing is frequently considered a form of off-balance sheet financing. Still, 8.4 is a strong coverage ratio. Computron is projecting significant improvement for 2020, using less debt and sufficient earnings to service that debt. Market value ratios are the only ones we'll look at that go outside the basic financial statements for data. We need the current market price of the firm's common stock. Incorporating the current stock price brings investor perception into the analysis. No surprise, high current earnings or expected growth increase market values. High risk decreases market values. The price-earnings ratio is widely used as an indicator of expected growth for the firm. With an expected market price for 2020 of $49 and expected earnings per share of $3.90, the firm's P/E ratio is 16.8. Book value per share comes straight from the balance sheet line, total common equity divided by shares outstanding. Market to book value gives us an idea of how the market perceives management's performance. Market to book in a healthy firm should be above 1. A market to book less than 1 implies that theoretically the firm's shares could be bought for less than the book value of its assets. While true value and liquidation value do not necessarily equal book value, the implication of a market to book less than 1 is still negative. Comparing Computron's market value ratios, we can see that both price earnings and market to book are still below average, though they have improved. This table recaps all the ratios we've computed for Computron. Clearly, analysis is difficult. Some are better, some are worse. How do we put this together and focus on what needs attention? As we move to the second half of Chapter 3, we'll address that question. This ends Part A of Chapter 3.